Let's answer a Money Track quiz question right here, right now.
All right, today's quiz question is, what is an index fund?
And your choices were A, a mutual fund that invests in index cards. I don't think so. B, a fund that invests to keep up with the cost of living. Or C, a portfolio of investments that is weighted the same as a stock index so that it mirrors the performance of that index. Well, we decided to invite someone special to our show today. Shauna Kroom is from one of our very favorite investing websites, Investopedia, and that is exactly what it sounds like. It's an encyclopedia for all things about investing. Shauna, welcome.
Hi,
and
Shauna.
How about the answer to today's questions?
Thanks, Pam and Jack. The answer to today's quiz question is C.
Yes, I kind of
Yeah, you did well.
Thank you
He
very
did
much.
well on
Every
that
once
one.
in a while.
That's right. An index fund is a type of mutual fund that tracks the stock market or a part of it. For example, the S&P 500, this is one of the best known indexes. It tracks 500 of the largest companies in America. So, if you purchase an S&P 500 index fund, you've essentially bought the Pfizers, the Microsofts, all the big companies in just one investment.
So this one investment gives people instant diversification, which takes all of the work out of having to go find the stocks to spread the risk.
That's right.
Okay. Now, we mentioned exchange-traded funds a minute ago, too, and we promised we'd explain any jargon. So an exchange-traded fund or an ETF, the difference between it and an index fund.
An ETF is essentially an index fund that trades like a stock.
So in other words, that on a daily basis where you can only buy and sell an index fund like a mutual fund once a day, these you can actually trade like stocks if you wanted to.
Day. That's right. And if the value changed throughout the day, so let's say the S&P 500 is trading high in the middle of the day, you can capitalize on those gains. Whereas with a regular mutual fund, you're going to get the end-of-day price regardless of when you bought or sold it.
Right, but put duct tape over my mouth. You didn't hear that because we don't like to tell people to trade. Let's segue for a second to something that ties together what we've been talking in the show today.
This is
okay?
really cool.
Is there an easy way to organize all of this in sort of a way you can see what kind of risk you're taking?
There is, and it is as simple as drawing a triangle. And let me just see, this is an easier way to see it here. At Investopedia, we have this great tool. It's called the Investing Pyramid. It's as simple as drawing a triangle, dividing it into thirds, as you can see on the screen here. At the bottom part, you'll notice that the base is the largest.
Right.
Now, as our caller in North Carolina mentioned, she had all her money in CDs. Her investments would fit in this bottom portion. But as John Bogle so wonderfully illustrated, you don't want to keep all of your money in there. Now, in this investing pyramid, as you move up, your risk increases, as does your potential return.
If you imagine that you take all of your money, everything that you have, you take the money from your checking, you take it from your 401k and from your wild investments in oil and gas futures, and you were to stuff it all into this pyramid, it has to go someplace, and by the time you're done looking at how much risk you're taking with each investment, it gives you a snapshot of exactly how much risk you're taking.
You can really visualize where your risk is in your current investments or where your investments maybe should be. As the caller just mentioned, her investments entirely in low-interest CDs are right at the very bottom. She's missing out on all of these other investments up here that could increase her return and have a, when you retire, you'll have more money that way.
So you want to have the majority of your money in the foundation.
That's right.
You want to have some of your money in the middle because if we have it all in CDs at the very bottom, we're just getting the lowest amount of interest or the lowest payback, and that doesn't keep up with inflation.
Give us an indication of what would be in the Summit.
The Summit, this is your speculative stocks. These are brand new penny stocks. They could be a big break or they could be a bust.
Something you feel like you can play around a little bit.
That's right. That's right. You know that if you've answered most of these questions and, hey, yeah, I have quite a large percentage here, you can determine where your risk tolerance is, and maybe you can also determine maybe you've taken on too much risk.
We were just talking about the index funds. Show us where an index fund would place on the pyramid.
The index fund would live somewhere in between the middle and the base section. Although it contains stocks, which are up higher within this middle section, it's diversified. Well, through diversification, you limited that risk of individual stock
so it
investing.
moves it down a little bit on the pyramid.
That's right.
Yes.
So you're not betting on just one stock,
No.
you're betting on the whole market.
That's right. I mean, these are the big companies in America.
In this case, The index funds, and we're not trying to suggest everybody should buy an index fund, we're just showing you that an index fund kind of grounds the whole process of investing in stocks.
That's
It's almost
right.
could be considered that you're getting the best of both. You're getting some stocks, you're getting a lot of diversification, and you're not taking as much risk.
That's right. What we've put here is a general guideline. You don't have to have those exact proportions in there. All in all, I mean, this is such a great tool. I think it'll be a really great benefit.
Yeah, this is an amazing tool, Shauna.
And we thank you so much for joining us today.
Thank you both.
Legendary investor John Bogle manages more than $1 trillion. Chances are, some of that money is yours.
Find out what he says works for everyday investors. That's next on Money Track.
Where any aspect of professional behavior and professional conduct and the ethics that go with the role of a professional have been reduced greatly, if not abandoned in many cases, in favor of business, business, business.